Boom, 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 boom. See, I think it's broadcasting, but YouTube is telling me it's not broadcasting yet. A whole window pops up. There's a big thing going on, but I think it's already broadcasting. So, if you are here, if you are live, please type in the chat so I can see we can begin. Okay, so it's not streaming there. All right, so something new, something different's going on. Let me try this. Oh, you're there. Hang on, I might now be broadcasting twice. All right, so anyways, I don't know what's going on, but you guys are there, so we'll just go. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Hey, good morning. I can't really, I got this whole thing in the way. So anyways, hey, good morning. Nice to meet you. My name is Wayne McDonald. I am the Chief FX Market Strategist for TradersWay.com. I preach to teach, because some of you never had this. So, thank you very much, Traders Way, for making this possible. They want you to succeed, therefore they sponsor this YouTube channel, because a successful, profitable trader does better. Cool, well then, Max, let me check it, okay? All right, yeah, so we'll figure that out. All right, cool. So anyways, please get involved. Please ask questions. We can cover technical and fundamental analysis. Today, I do want to go through the calendar. This is a very fundamental week. I told you to prepare for this week weeks and months ago. So this is the big week. There's lots of news on the calendar. So I believe it's also the turning point. By Monday, the year sort of could be over. Not meaning like you can't trade, but meaning the fundamental driving factors of normal business activity will be coming to an end. And things like taxation and stuff and year ends and business planning and all this kind of stuff just comes to an end. There's still trading you can do, okay? But it's slightly different, that's all. So anyway, so we'll go through the calendar. I can cover lots of technicals, and then I can answer your questions and all that kind of stuff, right? Cool. Andrew says, how come? I don't know. Do some research. Cool. So please visit tradersway.com, open an account, start with the demo, download MT4, test the execution speed, test the spreads. If you don't like spreads, do the ECN account. And of course, check out the amazing swaps. Okay, so let's start with the calendar. Welcome to Forex.Today, y'all. All right, so I can see, you can't quite see the whole. All right, so let me adjust my charts too. Look at the stars. There we go. Look how they shine for you. All right, there we go. How purty. Okay, how pretty. So what we want to do is dumb this down a little bit and only look at the most important things. You can add the other things, but this is what I want to cover today. Let's see if it's even got everything. Swiss National Bank. Okay. Fed meeting. Okay. Swiss National Bank, ECB. And then it doesn't have the UK stuff, does it? Okay, we got the election on Thursday, don't we? What's going on Thursday in the UK? Where are my Brits? So it's not an economic event. So maybe I'll switch it here and add it. Maybe it's a medium event. UK. Ah, so it's not even on here. Let's add even. Let's go everything. There we go. Wednesday, Thursday. Yeah, no UK, no matter what. Okay. Let's take that out. Let's take that out. So, what day is the UK stuff? Yeah, but when? It's Thursday, right? So anyways, let's break this down. Okay. Speech by Governor Lowe. Pay attention. Definitely watch it, read it, do whatever you need. But if you trade the Aussie dollar, that's something that you should. Okay. Then, down into here, we got Wednesday's FOMC, which the Fed is not considered to raise interest rates. You know this because we've looked at the pricing of short-term lending between banks in the interbanking system. Yes, Andrea, and I'm about to do that. Okay. I'm about to do that. It's high on my mind. All right, so anyway, so Fed, their Thursday ECB interest rate decision, Swiss National Bank interest rate decision. Okay. Also, Christine Lagarde is going to announce that she's going to start, what do they call it? A monetary policy review? Is it here? No, it's not even saved here. Does anyone know the last time the ECB did a monetary policy review? 2003. So it's a good thing for a new leader to do, to go in and like shake things up and ask questions about everything. That's how smart she is. So 2003, that was Jean-Claude Trichet, right? So that's how long it's been. So Draghi didn't pull those strings. Maybe he should have. So anyways, that's interesting. So we'll see what happens. That's obviously takes a while to do, but that'll be very interesting. In this Thursday meeting with Swiss National Bank, European Central Bank, we also have the UK elections. Okay, and that's going to be a big thing. And then I'm surprised it's not here either. But again, I guess this is an economic calendar. Yeah. The other thing not on this is Sunday. On Sunday, it is the deadline for the Americans and the Chinese to come up with a trade deal, right? It's widely that some deal is going to be announced. Nobody's expecting a good deal, just sort of like some kind of deal, some sort of truce. I think there's a good chance no deal gets done at all. And here's how I look at it. Having studied game theory, if you're trying to win, then it it's going to pay the United States to defect. We just found out that Chinese exports to the United States year over year is down 22%. That's a big deal. And yet, the United States is still booming. We're adding hundreds of thousands of jobs and still low inflation and all this kind of stuff. And holy smokes. So I'm thinking, like if they don't do a deal, there's still like $160 billion worth of tariffs scheduled to go. I think if you're playing the game theory idea, that's been scheduled to go. It's a go. It's always been a done deal. The Americans have never actually were interested in a deal up to now. Because here's how you do it if you want to win. And think about this if you've ever played poker. In the beginning of a poker game, the players that are weak and not very interested in the game, they don't play the game well and they're out really quickly just because they never were really committed. Okay? Then you get like the serious players, right? And they play hard and they play focused and they play the game right. And hours and hours and hours and hours get going, like go by. And then one guy keeps looking at his watch like, oh, if he doesn't get home, his wife's going to yell at him, right? Cool. Drag it out. Use the time against him. And pretty soon he's just like, throws the hand away. And then the next guy, he starts looking at his clock and he's stretching. He's like, oh, I'm so tired. And he starts throwing stuff down, right? Like they stop caring because they're so tired. And so having studied like negotiation strategy and game theory, what you do is you get to the point where one of the parties, if not both of them, are so exhausted and they're so tired, they just want it to end. You get to the table expecting to sign a deal, and then you pull a Columbo. And you go, oh, wait, just one more thing. And even though you might have negotiated for years, hardcore negotiations, they fold in the last second because you're just like, look, just one more thing. And they're like, all right, dude, just sign the deal. All right, I'll give that to you. Fine, let's do it. I'm signing. Okay? We're not there yet. And what do you think Trump wants? He wants to get the deal right before the election, not a year before the election. So anyways, if that goes down and the Americans don't sign the deal, US dollar gets really strong, Swiss franc gets really strong, Japanese yen gets really strong, but that already fits into my trade plan, right? Chris, Chris, are you talking specifically the swing trading session, the swing trading course on? But you're on the special. You told me to take this. The audio should be good on everything except I think there's one price action video it's soft, but the audio should be fine on all of them. So Chris, email me, wayne@fxbootcamp.com. Tell me what site you're logging into, what page you're logging into, what browser you're using. But you said you went for the deals, so it should be perfect. There's no audio problem. So email me, let's figure it out, all right? Together we'll get it done. All right, so anyways, guys, the trade deal. So we got the Fed meeting, which I told you months and months and months and months and months and months, that if I hadn't gotten out around the Thanksgiving period, I would be taking profit now. And it looks pretty good because I think, where am I here? Yeah, all my trades are profitable. So it wasn't a bad deal that I took profit 2 weeks ago. And now I'm setting up the other way, okay? No, Max. No. What I said was the Fed policy, once they've decided to stop cutting interest rates, would be bearish for the dollar. I didn't say I was bearish for the dollar. What I told you 6 months ago, 3 months ago, 3 weeks ago is in this period, right, for the next 5 or 6 weeks, I'm most likely going to be bullish the dollar. Then I showed you by buying a whole bunch of buying dollar versus a whole bunch of pairs a couple of weeks ago, and a whole bunch of Swiss francs, a whole bunch of yens to clearly show. Okay, so you're mixing up the short run with the long run. Okay, Max, a central banking policy is the general idea for an entire year, maybe longer. Okay. So anyways, Chris, make sure you email me, okay, guy? Wayne at fxbootcamp.com. We'll fix you real good. Okay, so anyways, I guess that's that. We can do some technical analysis. I guess I should that. But I just want to what I'm trying to show you with this is that I'm preparing not even just hours and days in advance, now weeks and months in advance, right? Now we have this period of will the port. I'll shut that down. Cool. All right. Let us do this. Let's go here. No, you're mixing things up. When the central bank, what we were talking about, Thanksgiving. I went from bearish US dollar to bullish US dollar. So you're mixing concepts up, Max. All right. So anyways, let's go through this. Okay. This is, no drawing tool. This is Kiwi Swiss franc. As you can see, we have a channel up and up and up and up and up. We're 2 standard deviations from the mean at resistance. This is where you should take profit, and it'll probably revert back to the mean. Where is the thing? All right, cool. Okay, so we have this 2 standard deviations from the mean, but below the mean. Now we're 2 standard deviations above the mean, and this is the projected high for the month of December. So you should be out. And now maybe, it doesn't have to, but maybe this sets up for a counter trend, at least back to the mean, but potentially to the low part of the mean. So this, right? This is something that if I was a bear, I would be selling. And in fact, you can see we hit this last week and it even gapped down. Okay? So you could look for pullbacks, you could look for double tops, but the idea, generally speaking, is there's target 1, there's target 2. Okay? Okay. Max, you don't have to look up the quote, dude. You don't have to look at the quote. Here's what happens. It happened last year, the year before, the year before, the year before, the year before. I've been doing this a bajillion years. Okay? Between the period of Thanksgiving and Christmas, if that's easier. Okay? Typically what I say is between the 3rd week of November and the 3rd week of December. Usually it's like 2nd week of December, but let's just make it easy. Between November 3rd week and December 3rd week, okay? You got that? The whole month process. We look at the market going from risk on to risk off, which means profit taking. So whatever that means to you, and you should know what this means, But there is a seasonality play here, not a fundamental play. Economic conditions haven't changed. Central banking policy probably hasn't changed. Now, I'm not just talking like this year, I'm talking every year. So whatever that means to you, you need to figure that out. But what I'm saying is during this period, those that get paid to trade must take profit. And they are going to try to hit their year-end bonuses. Also, investors, not traders, investors have to make taxation decisions. Do they want to get taxed this year? And there's sometimes good reasons for it. Or do they want to get taxed in 16 months from now? And there are other deferring taxes is also a strategy. But that means between the third week and the second week, let's say the third week of December and the second week of January, there's often more profit taking for tax deference reasons. But what I'm also trying to tell you is it's just human nature, not fundamentals. There's some logical reason for traders to get out of trades in this period. Trades they've been in since August, maybe like similar ones that I told you. Right? So what goes up must come down. Just like this mean reversion here. This channel, the trend is up, but right now we're selling. Right? Or you're at least taking profit. All right? Yeah, so so last year the decline happened ridiculously fast. So if you're not prepared, it's just going to go without you. Danielle says, is it a good approach to enter using a 2155 cross? It's just a different approach. There isn't good, there isn't better. Okay? So a 5A cross is more sensitive than a 2155 cross. But what I often teach you is you can wait for the 2155 cross, okay, which would take a long time, right? And then sell the next rally and take the next 5-8 cross down. Okay, so why don't you consider that 2155 cross first, and then the false rally on the 5-8 and take the next 5-8 down after the 2155. Okay, so I got to keep going, Max. I'm sorry, I've talked about it for weeks and weeks and weeks and weeks and weeks and weeks, right? So I'm assuming, right? So let me finish my technical analysis, and then maybe I can address it at the third half of the webinar today, okay? But I think most people get it. So I gotta move, man. I gotta serve the people. We'll come back to it though, okay, Max? All right, cool. So that's that. Let's take a look at pound yen. Let's go out to a 4-hour chart. Okay. Zip, 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 and what? What do we have here? This is last week's take profit zone, and this month's take profit zone. This month's take profit zone, okay, which together makes a zip, 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 lots of resistance right here. Okay, I shorted it here, and it's slightly profitable, but nothing major. So this is what I'm looking for now. So if I were trading this on smaller time frames, I'd look for a sell here. I'd look for a lower low. I'd look for a sell here. I'd look for a lower low, and I'd probably do the same thing over and over. Okay. Daniel, it doesn't matter what time frame, whatever time frame you're trading. If you're trading daily, it'll be the same on the daily. If you're trading a 5-minute chart, it'll be the same. You're just picking a time frame to look at, right? So the way I teach you is if you made a decision on a 4-hour, cool. Now you've made your decision. You're a bull or a bear. Done. So if you're dropping into a 15-minute chart, you've already made a decision strategically what you're doing. So whatever time frame you drop to, is a 10-minute chart better than a 15-minute? It's not better, it's just more sensitive. Is a 30-minute better than a 15? No, it's just less sensitive. It'll be slower, but more conservative. Like there's no better. They're only your point of view relative, right? So the analysis is all relative to your point of view, right? The theory of relativity. So there isn't better, there only is. Okay? You understand that? There's no better. You're just making choices. Okay? A big, powerful fighter is slow. A fast fighter is small. There's trade-offs. How much speed do you want? How much power do you want? Right? And all these different things, especially in military strategy, right? You're fast, but you have light armor. You're big, but you're slow, right? So there's just consequences of your choices. But there is no better. There just is. So if you decided on a 4-hour chart you want to sell this, good. Now you're done. See? You're done. Why? Oh, you're like, well, that looks like a take profit zone. That looks like a take profit zone. We have weekly and monthly confluence and congruency. So you're like, I'm a bear. Good. Great. So now you drop to a 15-minute chart and you make a decision. Was that 5A cross down good? I don't know. And if it's too slow, try it on a 5-minute. It just puts you in a slightly different price, but the strategy is the same. Maybe a 30 minutes better. Yeah. It'll put you in a slightly different price, but the strategy is still the same. Okay? Yeah, no, but that's what I'm saying, Daniel. It doesn't matter. That's your choice. Sometimes I trade a 1-minute chart. Sometimes I trade a 5-minute chart. Sometimes I change a 15-minute chart. Each higher time frame is less sensitive than the other. So it comes down to where I am, how aggressive I am, how strong the prevailing trend is. So would I be ridiculously aggressive on a counter trend? Heck no. I'm a ridiculous aggressive with the trend. Okay? But don't get this idea like, that one is better than the other, or I always do one thing and all that kind of stuff. Like I always use a 15-minute chart and that's how you should. No. You're making decisions. Okay? There's so many variables out there that you're making decisions. So in a counter trend trade, yeah, okay, maybe I'll use a 15-minute chart. Maybe I'll use a 30-minute chart. But if I'm right on my price and I'm like, hey, if I can get right on this price, then my stop is just above the highest high. So my stop would be only here. And that's nothing on this trade. So I'm like, you know what? I might be on a 1-minute chart taking this trade, right? So that would have been, right there, actually, right? So it just changes how close you are to your actual resistance. A 1-minute chart, you'll be really close. 5-minute, less close. 15-minute, less close. Hour, less close, okay? But they're all correct. Okay, gotta move, man. I want to go faster today. I gotta move. Give me some juice. All right, so 4-hour chart. What do we want? Let's take a look. Okay, we had this, and now we're sort of moving this way. Okay, based on my seasonality play, the 3rd week of November, or the Thanksgiving was up in here, if you remember, and that's where I wanted to be short my yens. So there you go. So I'm short the yen here. This is that trade that was sort of a poor entry, but because I took so many other yen trades down, this was a second chance. So by the time I realized I missed this, price was down here. So what I did is I threw a working order here saying, look, if this comes up, I want to take this down. And sure enough, I mean, that was like 100 pips away. I didn't think I'd even get it. Well, I did get it. And it put me into this situation. So I put a stop above resistance. And I think there was another thing up here as well. And now it's turned all the way back around and we're playing this range. And now the trade is profitable again. Okay. Do I feel good about it? Well, the only part I feel good about is this is part of my seasonality play. Okay. I'd feel better if I was up here or here, right? But no. So it's a mediocre trade, but it fits into the portfolio. And I don't want to move my stop yet. I want to give it some room. But you'll notice if you're a bull, you're a buyer now, right? You see that? So what I'll do is I'll give bears a chance. All we are saying is give bears a chance. Because if you're a bear, I know what you're thinking. I know what your trade plan is. If you're a bear, you're selling this, okay? So I want to have my stop just above that. So I reduced my risk by about 50%. Looks like my stop is just about 82.50. So in fact, I'm going to make it just above 82.50. And we'll let it go like that. All right, cool. Next. Let's do no, let's not do them yet. We'll come back to the commodities. Let's look at USD versus Euro. Now, this was an interesting one because this was impacted by NFP. And what I told everybody at NFP is if the number came out that I wanted US dollar to strengthen. Okay? Okay? I said that I want the US dollar to strengthen. I hope you guys were there. Okay? But I said, I want the US dollar to strengthen, but I don't think I'll get it unless we have a bad NFP. Okay? And here's the funny thing. It was a great NFP and the dollar still got strong. Okay? Okay? So, what does that mean? How do I take this? Well, it makes me feel good about my bias. Remember, my bias is just really an educated guess, right? And I said nothing on these charts will indicate that these markets are going to flip. That suddenly a bearish US dollar is going to get strong. Remember, the fundamentals haven't changed, right, Max? This is just profit taking. See, right? The fundamentals have not changed. So therefore, on the chart, nothing at that point indicated dollar strength because your US dollar supposed to be weak. Okay? So here's the interesting thing. I said, I know all of that. None of the technicals indicate this. This is not even fundamental analysis. This is really seasonality. It's a business cycle. And I start to look for dollar strength based on a business cycle, not fundamentals, not monetary policy, okay? Another sort of invisible force, if you will. So it's amazing that unbelievable, awesome news that should weaken the US dollar, strengthened it, and I wanted it to be strong. So we're here, and we're here. And I'm okay with this process because this is what I wanted anyways. And now it starts to make me believe my own nonsense, drink my own Kool-Aid, if you will, right? Which trade, Mike? Pete. I get stopped out a lot, so I don't know which one you're talking about. Okay? But what I want is down, up, down. And it may not happen this week. It may not happen next week. It may not happen at all in December. Think about that. I'm not telling you it's going to do this. Okay? What I'm saying is it might be this week, it might be next week, it might be after Christmas, but certainly by the first week of January, this will happen. You see, like I'm talking about 4 weeks, maybe 5. I don't think it's 4. But certainly by the first week of January, I full on expect euro dollar to come down, and euro yen to come down, and euro Swissy to come down. Doesn't mean I'm right. Right? Doesn't mean I'm right. It just means that's what I'm planning for. Okay? You get that? Everybody cool? Everybody clear? So with that in mind, I'm going to have plans. Oops. I'm going to make plans. So for example, if I look at this from a weekly point of view, Okay. I'm in my sell zone, right? I have permission from a weekly swing trader point of view to consider selling between 110.50 and 110.90. Okay. It's actually 110.60 to 110.87. Okay. I have full permission. Fire when ready. Okay. I'm looking at roll reversal as well. I'm looking at moving averages as well. I got full permission. Let's change now the point of view, right? Relative to your point of view. I'm going to change my point of view. And there's the daily. Now, based on my daily analysis, I also have permission to pull the trigger. Take a look at monthly. Okay? Monthly, I have permission. Right? So like you could draw it. I think I'm going to lose that though, right? You have that. And then you have weekly. Yeah. And then you have daily. Okay? And I'm allowed to sell. This one says 110.69 to 110.84, so it's a little tighter. It's not 110.60 and 110.90. It's 110.70, 110.85. So it's much narrower, but I have permission across the board on all time frames to take a shot. So now I could wait for something like a 15-minute 5A cross. Oh, look, I already got one. Or, like we were talking about before, I can let the 21.55 cross down, but imagine by the time that happens, price will make a lower low. That's the only reason the moving average is crossed. So then, the next rally up, I will get ready to sell, and then I'll take the next 5.8 cross down. So starts by 21.55 down, cross down, followed by the next 5.8 cross down. Next, which means to get the 5.8 cross down, you need a 5.8 cross up preceding it, which means there will be a lower high, lower low scenario. Maybe use Fibonacci, maybe use price action, maybe use these pivots, but nonetheless, to get the 21 to cross below the 55, you need a lower low. So now you say, okay, now game on, I'm allowed to be a bear, but I can't sell low. So now you have to wait for the next 5A cross up and then take the next 5A cross down, and you'll probably be somewhere in that point. Does that make sense? It's just fractal geometry, guys. It's not too complicated. You can get this. Humans are complicated. I don't understand humans. Fractal geometry, you can get that. Technical analysis in general, you can get that. Fundamentals, you can get that. Human emotion and human nature, that's very difficult. That one that's complex. Okay. Cool, right? All right, so now we got to do the commodities. Let's do the commodities again. Okay. Gold. Cool. Well, here's the thing. You have fundamentals of gold, and then you have the short-term fundamentals of dollar, and it's going to kind of... Yeah, PJ, just do the swing. I mean, there's new stuff in the training course, right? There's the taking control. There's the MT4 course. There's another one. There's 2 or 3. I think there's 3 new video training courses in the, right? But new meaning in the last 6 months. But if you've done all those, you should probably just join the swing trading group. Yeah. Okay. All right. Okay, PJ. All right. So what I was saying with gold is you have gold and you have its normal thing. But remember, gold doesn't pay a yield and stuff. It's kind of this thing. Like if you buy physical gold, the only thing you do is put it in a vault and never look at it again. My pleasure, Max. As long as you're happy, Max, I'm happy. We're a team, right, Max? By the way, I love that name, Max. What a great name. I always look for like powerful names. So I named my children powerful names, and no, I'm not going to tell you. But I named them powerful names because there's something about the positive affirmation, right? A friend of mine, his name is Ernest, and I like that name too. Like Ernest, like you try hard, right? That's what it means, right? Try hard. And I kind of like that. And then Max is it's just Max. It's full on everything, right? But I'd spell it with 2 X's. Because it's more than Max. It's like Max. It's 2 X's. Like 1 X would do, but boom, this is Max. So I just like that, right? It's not like minimum, right? Right? Here's my son minimum and my daughter lazy, right? Like mine. So anyways, what a great name, like Max. You get all of me and more, right? So yeah, it's just a cool name. But totally, I'm not joking. If I were me, I'd spell it with 2 X's. Like if I named a child Max, it'd be MAXX. Maximilian. Yeah, exactly. So anyways, okay, so this, what I'm trying to say is, gold is how we say in English. Let's look at it from an economic point of view. M1, M2, M3. Okay. Is cash in your checking account, cash in your hand, M1, M2, or M3? Yeah, but Andrew, that's perfect. You gotta have a good porn star name, man. Otherwise, okay, is cash M1, M2, or M3? Because remember, we're spot cash traders. We trade cash. Is cash M1, M2, M3? If you don't know, please type in a question mark so that I know you don't know. Because me knowing that you don't know then tells me where you are in sort of a fundamental economic education level. I believe this is out of fundamentals course. Yeah. Disaresta. If you notice something happens every year, that is by definition seasonality. Okay, TBM, strong enough to say don't know. Thank you guys. Team Sound Zone, you don't know. Move on, right? Cool, this is great. So by the way, just to put this in perspective, before technical analysis, when people just used fundamental analysis to trade currencies, one of the most important things is they would watch M1, M2, and M3 growth. So just so you know, this is a old school fundamental part of currencies specifically, monetary policy. Okay, So we know when a central bank comes into a market, they've moved interest rates through monetary policy. That's why the FOMC is meeting this week, the Swiss National Bank's meeting this week, the ECB's meeting this week, and they're discussing monetary policy, right? Now, all central banks have to worry about inflation. Some central banks, like the United States, also have to worry about the general economy. But all central banks, right, worry about monetary policy, inflation. And the way they address inflation or disinflation, which is different from deflation, is through monetary policy. They raise interest rates, they lower interest rates, and by doing so, they increase or decrease the money supply. By the way, does anyone get all excited when I start doing this? Because I do. I love this stuff. I'm like, this is good. Right? So by the way, now would be a good time to do the thumbs up and the likey and subscribey thing. That would be appreciated. Okay? So anyway, so there was a time 25 years ago when you didn't even know the central bank changed the interest rates. Can you imagine? Not only were central banks opaque, but they did like no press conferences. And in fact, there wasn't even an announcement. Can you imagine that suddenly, out of the blue, you say, well, I guess the Fed changed interest rates. I think it might have happened. What a difference. Like, you didn't even know. And even when something happened, you didn't even really know why. And then, so people looked at M1, M2, M3 because you knew if the Fed cut interest rates or whatever central bank you want to watch, that they increased the money supply through the process of decreasing interest rates or vice versa. They removed the money supply and increased rates. And M1, M2 are different measures of what money is. Okay? So let's say there's a huge financial crisis and the world goes into depression and you're filthy, stinking rich. Okay? But you're also hungry. Your children are hungry. Banks have collapsed. The economy's collapsed. It's the end of the world. Okay? Okay? Zombies are marrying vampires. It's like, whoa, this is nuts. And you go over and let's say the total sum of all of this is your wealth. Wealth meaning all your assets, right? Your net worth. Okay. And you say, okay, spouse, okay, children, I understand you're hungry. Papa's going to go out into the world and get you some food. So the first thing you decide to do is like, you know what? I'm going to take my Monet off the wall. Not Monet, Monet. And you're like, oh, this is cool. I'll just go out onto the street and I'm going to raise some cash so I can buy some food, right? So you're like, hey, I got this Monet. How easy is it to convert a Monet into food or into cash, if you will? But you only want the cash to trade it for something, right? So you want a nice ribeye and some fresh vegetables for your family and maybe some nice French wine. Not that Bordeaux crap, but you want some good Rhone, Southern Rhone, Chateauneuf de Pape or something, right? And you're like, I got this Monet. In a world like this, is it easy to convert your Monet into something that you want? Your Renoir, your Mickey Mouse. Have you ever seen people go to Disney and drop like 20 grand on a Mickey Mouse picture? I'm like, dude, it's Mickey Mouse. But I love him. Mickey Mouse, that's me. How much would you pay for a Mickey Mouse? Right? So yeah, it's very, very difficult. M3 includes all your assets that can be converted to cash, but the difference between M1, M2, M3 is liquidity. How easy is it to dump your house in a bad market? Your house is worth $1 million, and you're like, oh man, I got to get out of this. I need to raise some cash. It's not very easy to dump your $1 million house for $1 million. Okay? So those kinds of assets are into M3. M3 includes M1, M2, and M3. Okay. Now cash, okay? So we'll put art here. We'll put art. Okay? Well, I guess I can leave the wealth part. Okay. Okay, so there's art. Now cash, okay? Let's change up the situation. You go to the grocery store. Okay, the zombie apocalypse and vampires and all that, that's gone away. Let's just talk about today. You decide, I need to buy food for my family. Okay? So you go to the grocery store and you're like, I want a gallon of milk, I want a loaf of bread, and I want a dozen eggs. Is it easy to give cash and receive those goods? And of course, the answer is yes. And the funny thing is it comes down to how much is milk? $2.79, and a loaf of bread, another $2.79. So that's let's say $5.50. And what was a thing of eggs? Another $2.79, $8. So it's $8.13. Okay, cool. Can I dole that out in cash? Specifically $8.13. Well, I can pull out a 5, 3 ones, and then pull out some coins, right? A dime and 3 pennies. Or I can hand over, what do you call them? Checking cards that goes to your your checking account, bank card for people that can't get credit cards, right? And so you can just swipe a card and the exact $8.13 gets transferred, whatever. But we're really talking about cash here, right? But you're using your bank card comes out of your checking account, which is also considered cash because it's on demand, right? It's on demand. Okay, so you can really, it's breakable because as you know, right, money is a unit of account, right? A medium of exchange, right? What's the third one? Unit of account, unit of exchange, unit of account, medium of exchange, and what, store of value, I guess, right? A debit card. Thank you. I haven't had a debit card like forever. So anyways, so that's on demand cash. Okay, so now let's get to what we were talking about before. Gold. You decide to go to the grocery store, buy a gallon of milk, a dozen eggs, and a loaf of bread. And you got an ingot of gold. What do you do with your ingot of gold to raise $8.13? Because you're not going to give over an ingot of gold, right? It'd be like $22,750 worth of gold. For the egg, the milk, and the bread, that's too much. So how do you do it? Do you take out a knife and shave off the smallest 1/10 of a gram, 1/100th of a gram, right? 1/100th of an ounce, and it would still be too much, but you couldn't get 1/100th of an ounce. And even if you gave them like a speck of dust of gold, what are they going to do with it? So what do you need to do with gold? Because people say, gold's the same as money. No, it ain't. Well, Cash, I'm giving the example of of gold, but you can do silver as well, right? What is it, 13 bucks for silver? So, okay, you need, what do you need? 0.72% of an ounce. You see what I mean? Right, Cash? Like, it's not quite accurate. So what needs to happen is you need to convert your gold into money first. And then with your money, buy the food, right? So cash, right? Cash is liquid. Gold is still quite liquid, but you still have to convert it. Now, you won't have any trouble converting gold into cash. There are plenty of ways of doing it, but you're going to have to go somewhere, a refiner, a buyer of gold, you know, these stores that say, hey, look, come here, we will buy your gold. But now, you know, gold is trading, let's say, at 1,300. How much are those guys offering you? 11? So you have to pay a spread. Whoever's buying it, there's always going to be a spread. And you have to take the time, like you have to go there. And if you have $1 billion worth of gold, you might want to pay for some security and all that kind of stuff, right? But there's time involved. You can't do it on demand. You're going to have to convert your gold to cash. And then you walk into the grocery store and you pay the $8.13. So the liquidity here is the issue. Okay? You can convert gold, but you're going to have to find a buyer. And the buyer will transfer cash to you. But that takes time. Same thing with a home, a piece of real estate. You will need to find a buyer. And in an up market, that's pretty easy. In a down market, it's not that easy. So it's illiquid. Gold is more liquid than art and real estate. You can always find someone to buy gold, but there's carrying costs and there's spreads to, right, and all that kind of stuff. But it can be done, but it takes some time. So it's more liquid than art and real estate, but it's less liquid than cash. It's not cash. You will have to liquidate the gold, convert it to cash, and then the cash can be a medium of exchange between you and the grocery store. And then cash is cash and cash is cash. And that's why cash is king, because you can't eat a bar of gold if you're hungry. Have you seen the scene in the movie about Pablo Escobar? And he's on the run now. All the police are after him. He's escaped from jail, I think it was. And so he needs somewhere to lay low, right? There's hundreds of cops all over the place. So he goes to an old house and he remembers he has a stash there. So he goes to an old house in the middle of the jungle and there's no furniture and the place is all moldy and no one has lived there in years. And and it's dark and it's cold. Well, cold for him. So anyway, so he's like, oh yeah, I think it was this wall. So they bust open the wall and it's filled with millions of dollars worth of cash. And they're just burning piles of cash. Right? Put on another 20 grand, I'm cold. And they're just throwing money onto the fire to keep warm. Right? So anyways, like, you can't eat cash either. It's just easier to convert for the things you want. Okay? Gold is harder to convert to the things you want. Art and real estate, much harder to convert, right? And all of this is wealth, right? All of this is a form of, they're all assets, they're all a form of net worth, but the amount of liquidity is what matters, okay? And so adding liquidity to the market is like adding cash into the market, right? So I forget where we started, like, to go full circle here. But there's been 1,000 chats, but money supply is broken down on those three parts. Okay. So what were we talking about here? Oh, gold. Okay. So gold is something that you typically buy, you sit on, and you just, right, just let it kind of run forever. Unless you're going to make something out of it, you're going to make like an electronic component or you're going to make jewelry. But much of gold is purchased and just sits in a vault and is an asset. It's a fairly liquid asset. And right? And you can go anywhere in the world with your gold and people will accept it. But it needs to be converted. I don't think it's a movie. I think it's the series on Netflix. Narcos. Narcos, the first season, I think. It's really good too. He goes to his old home to see his father, and his father still thinks he's a disgrace and worthless, even though he's made billions and tens of billions of dollars. But now he's got nothing. He's in an old dirty tracksuit. They're in a junky car. They're running for their lives. So he goes back to his old home to see his dad, and it's just impoverished farm. And he goes to a spot where he remembers burying money just in case, and he digs it up. It's been down there for 20 years, and he digs it up. And it's all sealed in plastic, but they open it up and it's all just rotted and molded away. Completely worthless. Oh, is that right? Hope says there's several. Yeah, if you need to know anything about drug dealers and drug dealer life, ask Hope. She knows. She's seen them all. Seen all the movies. Thanks, Hope. Oh, wicks being filled. That probably is just people selling into an up market and creating a wick. But I've actually never heard that term. So you're listening to someone in particular. All right. So anyways, is there a big desire? Like if you owned gold for the last year or two, is there a giant desire to bail on it right now? Probably not. Oh, Al Pacino, sure. I watched The Irishman, and it was okay. In the beginning, I'm like, nah, this is terrible. And then you kind of get into the story, and you're like, it's okay. And then the ending was so sad. Like I went to bed like sad, almost in tears. My wife's like, "Oh, you're up late." And I'm like, "It was sad." I just feel sad at the end, man. I feel sad at the end because it ends like humanity ends. It was terrible. So, anyways, those holding gold, I don't think there's a dramatic reason to get out, right? Like, what you would have gotten out at 1500. Um, and is there a major reason to sell this? There'll be some dollar strength, let's say, for a while. I don't think it'll be forever, but I think that it's coming. But I don't think it's going to push serious gold holders. Like people with gold in their vaults. It they're not going to dump their positions. They right? They're holding it for other reasons. So really, I think the major right, and there's no inflation to hedge. There's not going to be inflation next year anywhere in the world. So you're never really like you're just holding it as a store of value. And because here's your other choice. You can buy an a euro bond and be guaranteed by the European Central Bank only to lose 0.25 or something. Okay? Guaranteed to only lose 0.25. Or you could hold gold as your store of value instead of a European bond. There's really no difference because you'll say, oh, well, Wayne, gold will not lose money. Well, gold could lose money. Euro bond is a euro bond. You're guaranteed by the ECB to get paid back at face value. And you're also guaranteed to lose money, but hardly any money. And in a world where you might be worried about risk, losing hardly anything is better than being exposed to losing a lot. Now, you could also choose to put gold in a vault. And gold is gold is gold. Now, can the value of gold go down? Yes. Will the value of gold go up? Yeah. Is there a major reason like inflation hedge? we're not going to have inflation this year, next year, the year after that. We're going to go like, I'm not joking, we're going to go like 10 years without inflation. If you don't believe me, ask Europe. And if you don't believe the Europeans, ask the Japanese. They haven't had inflation for 30 years. Okay? Okay? Now, if you put gold into a vault, you have to pay the vault people, the security people, right? So there's your negative 25% or whatever that is. So if you buy a European bond, you're guaranteed to lose a little bit. If you buy gold, physical gold, you're guaranteed to lose for carrying costs, but you also might lose in asset value, or you might gain an asset value. And some people might just say, you know what, the might part I don't like. Okay? And the other people are like, yeah, well, what I'll do is if it goes up, that, you know, they're willing to take the risk. But can you see how it's a little different than maybe some of the other markets? Okay? Demand for... Oh, are you saying Paul Volcker just died? Oh, man. Really? Oh, man. Well, you should read his book. He wrote a book 2 years ago. If that's true, if Paul Volcker just died, you should go buy his book. Maybe when I start my book club, that'll be a book we read. Hope says gold to trade to 1800. Well, the issue is when. Okay? The issue is when. Like when someone says, oh, it's going up. Well, the first question is why. So you'd have to explain to me why. So right now, global macroeconomics are down based on things like trade. Trade is low. Australia, right, is supposed to be exporting. It's not exporting. Europe is supposed to be exporting. It's not exporting. China is supposed to be exporting. Well, exports to the United States year over year from China is down 22%. And the only country in the world with a consumer that's buying anything is the United States. So where's the demand for gold? Well, in the United States. Right? And that's because the gold is being used to make electronics and jewelry. But I think if you look at the world in general, there's less than normal amount of demand. Okay? So you have your long-term trend, and then you have economic cycles, above normal, below normal, above normal, below normal. And we're probably like this. Okay, we're below normal demand for gold. So you're saying maybe that earlier this year was the lowest ever. Okay, that could be. And you're saying eventually we'll head back up and we'll head toward 1800. Okay, but you might be talking years, certainly months, right? You can't look at this chart and say, let's just do a normal kind of, okay, you can't look at this, I don't think, let's go weekly, okay, and say, like for example, will this go to 1800? If I'm using technical analysis now, I'd say you're not getting above this 15 area without a massive fight. So if you're going to 1800 and I'm using technical analysis, the next thing I'm going to need to do is find the massive support. I'm going to say about here. So we're at 1500, let's say. And if we're going to 1800, we're probably going to go to 1400 first and then up to 1800. But that might be all of next year, right? So we got to be careful with our, make sure you have plans and not guesses and stuff, okay? Because most people can't survive a $100 to $150 decline if you're leveraged and you're late. Nothing worse than being leveraged and late, okay? So the way I'd rather say it than this is going to 1800, I'd rather say generally you're a bull. We're going through a decline, right? You'll probably get a 50% retracement. And then you're a buyer of gold around 1400. Okay? Probably it could drop to 1350, but let's just say around 1400 you're going to be consider being a buyer, and that this is going up. Okay? And then you'll be able to adjust as you go. Okay? But remember, gold goes up based on demand for the physical commodity, because you're going to make jewelry. If you're a jewelry maker, you need gold, you're going to make jewelry. This is because you then make the jewelry, M3, it's an asset, and then you sell the jewelry in exchange for cash, so you can pay your rent and pay your employees, so you convert it into labor and to capital. And if there's any left over, then there's retained earnings. You've converted gold to jewelry, then you converted jewelry to cash, and then cash to pay for labor and capital, and then leftovers retained earnings, which then you buy your yellow Gallardo, right? So demand right now is low. Maybe in the next 6 months it won't be. But you'd have to say, well, yeah, Europe is coming back on board for sure. Oh, China is coming back on board for sure. Oh, and that will bring, Canada and Australia, New Zealand back on board. And boom, everyone's going to be rich again in the next 6 months and start buying fancy jewelry and fancy computers and fancy TVs. Is that really what you believe? Right? Like, really, right? You should think about that. Is that what you believe? If that's what you believe, then that's your analysis, that's your alpha. And if there is increasing demand, then the value of gold will go up. It's simple supply and demand. And if you believe that increase of global economic activity will lead to higher jobs, more jobs, higher wages, increased consumption, and thereby inflation, then that would probably also push the price of gold up, and then would increase the demand for gold to hedge against that inflation, which would then further push gold up. Are we there? Is that what's going to happen in 2020? Remember, that's all you have to do as a professional investor. Be able to sit down with a client and say, this is how you analyze things. Over the next 12 months, over the course of 2020, you see these three factors pushing up demand for gold, pushing up demand for jobs through increased economic activity, which would then push up wages, which would then push up consumption, which would then push up inflation, which would then also jam up interest rates from negative to positive and then up and up and up. And because of all of this stuff, over the next 12 months, you believe there'll be a significant move in gold from as low as 1400 to as high as 1800. Is that what you could say to a potential investor? If the answer is yes, then you do it. If your answer is no, that Europe won't fix its problems, that China and the United States will still be in trade battles, then there's no increase in demand from economic activity in China. Then there's no increase in economic activity and trade between resource providing nations like Brazil, like Australia, like New Zealand, like Canada, like Argentina, even oil producing countries, right? There won't be increased demand. Why? There's no economic activity. If factories are not humming, right? If China's not exporting, if Germany's not exporting, if Australia's not exporting, then oh my God, where is this coming from? Okay? So I want you to think about it that way. It's just a simple economic exercise, but you should be able to put that together even if you don't have an economics degree or background. You should be able to think about it like, why would prices go up? Why would demand go up? Now, Hope says, okay, well, I'm a bear then. Well, no, you can't be, Hope. You just told me it was going to 1800. One dude shows up and convinces you otherwise? Don't make me mansplain you. There's a girl in my cohort, and one time we're all having a conversation. She's saying something, and someone says something back to her, and she's like, "Don't you mansplain me." And it was good. She put him in his place. She's like, "Hey, I'm in this cohort too. You don't have to treat me, like I can hold my own, yo. You don't have to explain that to me." I thought that was great. Okay. You're talking short term? That gold is going to like pop to 1800 in the short term? All right. Okay. You should be able to explain it. What I don't like is when people say this is going to 1800, right? And I'm not just picking on you. I do this to everyone that says this. Like they come in, they're like, "Oh, pound dollar is going to tank." I'm like, dude, don't say that. Tell me how, explain to me how, why, measures of this. And 99% of the time, they don't got jack except a stupid wild guess, right? Right? So I don't want to hear that, right? Oh, pop, now you're saying no pop to 42. So anyway, I like to hear more because in most situations when it's professional versus professional, we've done our analysis and our opinions are based on our observation of what we've seen in the data, right? Data analytic opinions, if you will. So often we're both right. And you should both be intrigued. Both professionals would be intrigued like, "Oh, well, why do you say that? What do you see here? What about this?" And then you have this like lively conversation. And very often it's long run versus short run, and or variable switches the other way. Like, oh, Trump does do a deal with China. Well, that would change things, right? So it's like, oh, wow, why do you see it that way? Oh, I see, right? Or like in finance, it's great. Like you can value a company. How much is Nike worth? You can get like 5 financial analysts together and come up with 5 different numbers. Okay? Right? Market cap is not a valuation. Okay? So you could break it parts and like, oh, well, what did you discount with? And what was your whack? And what was this? And what was that? And, and multiple analysts will come up with multiple answers because you have your fixed numbers and then you have your variable numbers and like things like your discounting rates and stuff and projected inflation rates and projected costs and all that kind of stuff and risks. And you can say, well, overall, kids are not buying Nike anymore, or they're not buying $100 shoes. They're less brand oriented than the previous generations, and that might be a risk, and therefore maybe Nike's market cap is overvalued. And right, so but these are all negotiations, right? And so it'd be interesting when those analysts got together and then debated what the right discount rate, what the weighted average cost of capital is, and all this kind of stuff, right? And they debate and say, "Oh, you're crazy. I totally disagree." Or, "Oh, wow, that's really interesting. So why do you? So what if? Right?" So that's why I don't want people to come out and just say, "Boom, this is going to 1800." I'm like, okay, let's talk about it. How do you get to that? Because I don't see a dramatic, I didn't say none, but I don't see a dramatic increase in economic activity globally over 2020 that would dramatically increase the price and demand of gold, either as an inflation hedge or as a physical commodity. Right? So then I would say, well, I'm struggling to buy into your theory. Not that it can't go to 1800. I'm more interested in like why. Because if I understand why, I can probably figure out when. And if I can figure out when, I could probably figure out what price. And at what price, then now it's just time. Okay? Does that make sense, guys? But since I don't know the future, I don't care what the number is. I'm more like, well, why do you think that? How do you break it down for me? Because if you and I can have that conversation, then you and your clients are going to have that conversation. I can have a conversation with someone and say, I would be a buyer of gold because I think it's going to 1800 over the next 12 months. Let me explain why. There will be a Trump deal. There will be an increase in economic activity in China. There will be increase in demand for raw material from countries like Brazil and Australia and New Zealand and Canada and all OPEC countries. And therefore, the price of copper is going to go up. The price of gold is going to go up. The price of oil is going to go up. And because of this increased activity and the increase in asset prices, but also in particular commodity prices, then that would be the impetus to create inflation globally. And with the increase in inflation, specifically from oil, then you'll start to see the desire by central banks to have negative interest rates or zero interest rates diminish, and they will start moving away from things like quantitative easing and negative rates to at least a neutral stance. And when that happens, I would see this and this and this. And this is my next play. Okay, you should be able to go both ways with your opinion so that you can understand what's happening when you're interpreting this and you say, oh, now it's time for gold to make its rally. Okay, is that cool? Too esoteric, right? You're like, too esoteric. All right, so why don't I open it up now to... let's do some technical analysis. I will take requests. I think there's a bit of a lag today, so we'll try to keep this to minimus. But let's get some of your questions addressed. Okay. Thank you, guys. Yeah, someone who said it, the chat moved, but someone said something about, yeah, it wouldn't be prudent to expect a pop without some exogenous shock, right? Like suddenly there's a huge increase in demand. Well, why? And what would be that shock? And you should be able to plan that stuff. WTI, didn't we do it? I thought I did it. I must have got stuck on gold. I apologize for that. All right, let me go back to WTI then. Yeah, I must have forgot it. Yeah. Okay, WTI. Same as before. So let's go up. This is the sell zone, as we talked about previously. This is the buy zone off of the 4-hour 21. There's also a roll reversal in here. Okay. So if you're a bull, you've definitely had buying opportunities over the last 4 hours, in particular off the 21. And that if you're a bear, the next thing you're looking for is either a lower high off of this point. So let's say kick off 59, or a double top, which is a rejection off this pivot zone, right? So in this case, if you're a bear, you'd be a seller between 59 and 60. Okay. And if you're a bull, it's just you're buying off a 4-hour 21, right? So you should have been long just around there, or 58.50, which is kind of where we are now, but it should have been closer to 58.20. Okay. So we can go into like when you're hitting that 4-hour 21, you should be on like a 5-minute chart when it's happening, right? And then all of a sudden, pachow. Like, look how important that 4-hour is. Okay. What we're looking at is this. Okay. It fell for a day, and then we know right here is the 4-hour 21. So let me do this in a similar color. So we know right here is the 4-hour 21. 4H21. That's why you do your strategy on a 4-hour. And look what happened. Daniel, I almost always manually enter my trades. Almost always. Not ever, but almost always. Okay? So that's the basis of a trade plan. If you were a bull, you start on the 4-hour, you're like, oh, I'm buying this 21. It's, again, standard technical analysis, standard operating procedure, right? It's in the book from 13 years ago. It's classic, okay? 4-hour 21 is your strategy. And now your tactics is, huge bullish engulfing candles. And then you see here, you got your Fibonacci retracement. Like, you just know you're not missing these things. If you're missing these things, you don't have trade plans. That's all it is. You're not planning your trades in advance. So again, right here is the 4-hour 21. Dude, at what point do you get on the clue train that it respected the 4-hour 21? Okay, then you fib the sucker, and you know your sweet spot is between the 3A2 and 618. So it drops down there, take 5A across, you're long gone, easy peasy. Okay, now that's long and gone. If you haven't done it right, you're either on a higher time frame or you're really slow. Okay, you're really slow. Now, if you're a bear, you're planning your move. Oops. Okay, bulls have had their chance. Doesn't mean you won't have yours. So at what price would you consider selling if you were a bear? Well, I already analyzed this one. So let's say near 59 is the first one. And then how do you want to play this? There's the weekly up there, monthly here. Let's do it off the monthly. So 59.30. Let's call it 59.50. Okay. All right. So there's plan A and plan B if you're a bear. So now you drop into maybe a 5-minute chart. And you say, as you approach this line, which is the 2618 of the entry here, then you are going to look for a rejection. Just like here you were looking for a rejection up, here you'd be looking for a rejection down. So you might see price go like this, like this, like this, like this, like this, then like this, like this, like this. Okay? And you should be short here about 58.95, and down she comes, and you'd be short for a long time, probably till the end of the month, because that was the whole part of your plan anyways. Okay? The thing that makes you rich are your plans. The thing that makes you poor is you don't have a plan. Okay? So what is your plan? And I've told you 1,000 times, I don't care if you're a bull or a bear on here. If you're a bull, you would have caught that trade, you would have made money. If you're a bear, you're planning your next trade, and you're probably going to make money. If you're not a bull or a bear, you're losing. You're going to lose. You are going to lose all your money. So you might as well flip a coin and at least have some consistency. Okay? Cool. Nat gas, 2 standard deviations from the mean. That's interesting because historically, I believe nat gas has an inverse relationship to oil. I don't know if that's always been true, but in this case, if nat gas is historically inversely related, and the standard deviation in the channel suggests an upward move, then that would suggest, because it hasn't happened yet, if that happens, then that might suggest a downward move in oil, and that's what we just planned to the downside around 59. Oil goes up to 59 and then comes down. Meanwhile, nat gas is going up. I don't know if that's going to happen, but if it did, it would feel really good, and if it didn't, I'd just say, oh, I guess the correlation's busted. I guess I have to account my waves differently. Okay. Okay. All right. And Brent, I guess we can do some Brent here. Look at the stars. Brent. 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 Okay. Riding the 21, long and strong. We call this an OOP, but here's the issue. Do we really think it's doing this? I don't feel that in my bones yet. Okay? I don't think that's happening, right? So what would happen? Double top at M3, and then we're targeting down here. Another thing, and this is a little bit of finesse here, so you can believe it, but take it with a grain of salt. Up to the R1. Oops, I want to do that in pink. Up to the R1. Okay, and down to the S1. Inside week. Okay, and this also might have to take all week to do it. And then down next week. So maybe up to 66, down to 62 next week. And that would be part of my risk off profit taking idea. Right? So if oil's coming down, CAD yen's coming down, CAD Swissy's coming down, but I'm already planning that. So yeah. Okay, now if it does this, we have a big, technically significant breakout. YolanFX says not now. I don't know if you're commenting on what I said here, but I'll tell you why not now if that's what you're commenting on. If it's now, you're going to sell at 65.24, and your target by the end of the week is 60.78. And that's just a little bit too low. And it's even possible that you go even lower to 59, right? So let's just say down to 60. I don't know. Are we ready to go from 65 to 60 this week? Yeah. It could. Let's say based on my other things like seasonality and fundamentals. But technically, because now we're analyzing the probability of such a thing occurring, technically it's not likely. Fundamentally, it's possible. Technically, it's not likely yet. So I would think at least a double top here. Spidey senses tell me maybe even a little higher. And then down. And of course, we have Swiss National Bank, right? We have the FOMC. We have the ECB. And we also have the UK elections. So there's a lot that can happen here that can force things like gold up or oil down or Swissy up or yen down, right? So, I don't know, be careful. And using this analysis that we've used for weeks, it just doesn't say this. That would be, in statistics, we'd call that an outlier. And you shouldn't plan on an outlier because that becomes a bet. Because they're statistically unlikely, right? So that's why I want you to pay attention. Like, what is statistically likely? Okay, well, the first thing is if you're swing trading down, you're thinking M3 to M1, but that's even an outlier. Okay, or if you're a bull, you're thinking from here to here, but that's statistically an outlier. So what is more likely? And I'm like, well, this is just slightly out, and this is just slightly in, and then therefore that the regression would, the channel would adjust, but only slightly, and we'd have an inside week. And then, like, again, I don't know if that's going to happen, and nor is it even my opinion, but I'm just saying this is statistically more likely than upside outlier or downside outlier. Okay? Does that make sense? Yes, why, thank you, Wayne. That's an excellent idea. Well, thank you, Mickey. Yeah. Let me go back. Pound dollar was another one. Okay. I look at this and it's just danger zone. Okay. It's overbought. Lots of geopolitical risk. Not interested. Okay. It's overbought. Don't want to get involved. Too much geopolitical risk. Remember, I'm not like a activist investor or something, right? I just want to make money. I look at that. I'm like, I understand it's going up like a ton of bricks and some, you know, I get the idea that the pound was way oversold. Notice this has been going up since the third week of August. Okay, so I understand it's been way oversold. You know, it wasn't the end of the world in London. All London businesses didn't shut down, right? Cats were not living with dogs. Princes were not marrying barmaids. And, oh, well, all right, cats were not living with dogs. But anyways, but I have to decide, is that where I want to get involved? I'm not entirely sure. So let's do another one. I'd rather look at pound Swissy anyway. So let's do pound Swissy just out of interest. Okay, we're on an R1. Okay. So we need this to come down. Psychological level of 130. We've been fussing around it. Technically, this is bullish. So if you're a bull, you're buying a dip. You're going to plan that off of here, or you're going to plan it off of here. And if you're super aggressive, this one, okay? Yeah, and so maybe even 4 hours is too slow on this one because of the amount of volatility. So let's clean this up. There's the 4 hour 21. So your first aggressive move, and this is indicating it's a little too aggressive, But your first plausibility, if you will, as a bull is to take this off of there. And you're using this as your role reversal. But you've breached the 21, which will tell me that, if anything, what is more likely is that this goes up, this goes down, this goes up, this goes down. And now we're hitting this 21. And that now poses a problem because it's not certain if it's going to go here or up and down here. And that uncertainty helps me because I'd like to be a bear. I'm not saying I am a bear. I'd like to be a bear on this over the next 5 weeks. Doesn't have to be this week. Okay? So, yeah, so this is really, to me, technically speaking, on this time frame, on an hour, setting up a double top and then a drop. And then a bear would be selling there. So what would happen now is you'd go back up to 30.50, get rejected, drop below 130, and then retest 130, but now 130 is resistance, not support, and I would fire here. Not because that's what you're supposed to do, only because I'm a bear, and I'd have a double top, lower low, lower high, 1, 2, 3, roll reversal off 130. I'd take that shot every day of the week. Most of the time I'd hit target. Anthony says, I asked you about Euro Kiwi from last week 3 times now. You have not once. Take a look. Well, you have to understand, Anthony, that I look at my charts 98% of the time. And then I look at and I say, hey, I ask you a question. I don't see most of the chat. There's no way I can see most of the chat if I'm answering questions. So it's nothing personally, Anthony. But this chat goes by, and I only see 1, 2, 3, 4, 5, 6, 7, 8, 9. So every time I answer your questions, probably 27 chats are posted. I only see the last 9. So statistically speaking, I'm not likely to see your question. But out of respect for Anthony, don't want his feelings to be hurt. What was it, Kiwi Swissy? What did he see? See, already your chat is missing. It's already been chatted away. Euro Kiwi. All right, so Euro Kiwi. So I don't even have a Euro Kiwi. So Euro, I have to go to a Euro setup, I guess, right? Oops, come on. A Euro Kiwi. Guess I'll go here and see if there's a Kiwi. Euro ZAR, Euro Pound, Euro Swissy. There's your Euro Kiwi. Okay. Cool. So what do you want to know? We started the month out of position. There's only one possibility, and that's to sell off the 4-hour 21, which you had on the very first day. And now here we are on the 6th or the 7th or 8th day, right? This period here, we've already hit our targets, so you should be done trading. But it's not a good trade in the sense like that's all you had, and you should be out really back here. You should have been done probably in the first 5 days. So it's not a good setup. Now you might say to me, or you might argue and say, well, Wayne, this is clearly a downtrend. Oh, I know. And that it's been falling fast. Yeah. So I'm not saying it's bullish. I'm saying is based on technical analysis, the vast majority of the lower risk, or let's say not lower risk, but anticipated pips, the kind you can plan, okay, that is done. This is what you would plan for. If you sold here, you should take profit here. And you got that in the first 5 days. What happens next is unplannable. Yes, you can sell at the future 21 and try to take it down further, but I wouldn't do that because I have rules of engagement. Okay, if I sell here, this is my target. If I sell here, this is my target. If I sell here, this kind of area is my target. So I'm done. So this is an OOP. This is a plan A. This is a plan B. And all targets, no matter what plan I would have taken, have been achieved. The low-hanging fruit is over, and I'm done. Now, typically what happens is, you can get a counter trend move here, and sometimes, not always, it continues down. Well, I'm not obligated to take the counter trend, and I certainly, every pip below this level here, every pip in that black space is high risk pip. I'm not interested in that. So the way I teach people is, if you were a bear this whole period and you did sell here and you did get this and you hit December S2, well played. Take your money, take the rest of the month off. Happy New Year. Okay. Yeah, so Anthony says, I've been short for 2 weeks. Good. It's done. I don't know where it's going to go, but trade planning, my form of technical analysis that I teach, says the obvious is done. What happens next is much less predictable. And if it's much less predictable, another way of describing it is risk has increased. Okay? Right? So if you're hanging on, it's because you don't have a target, you don't have a plan, and you're like, oh, well, what if it goes farther? I hope it falls further. But that is not discipline. It's hope. And hope's not a strategy. Okay? You understand? So do what you want. I'm not talking you out of it. I'm just saying the targets have been hit. Like, you should take the rest of the year off. Or jam your stop, but be prepared at the very bare minimum. The very minimum risk you're assuming right now is up to 170 and down. So if your stop is below 170, why don't you just take profit, dude? And then have your next plan be sell between 69.5 and 70. Right? Like, you should have just taken profit down here, or like you're supposed to here. Right? Not be exposed to the risk. Not be exposed to the stress. And instead say, hey, if this fades up to 69.5 or 170, I'm going to dump it again. But at least you're out, money in the bank. But the whole idea of hope is just terrible. Right? Because then you just literally don't have a target. So I don't know where you sold or why, but if you're hitting this zone, this, in particular this pivot right here, and you're not taking profit, then you are not using technical analysis at all. Okay? You're using hope or emotion, or you're not using pivot points, which is fine too. You can say, I don't use pivot points. But if you do use pivot points, then it's clear. Technical analysis and the discipline to carry out your plan tells you, like, you're done. You're done. That's it. There's no hope. Yeah, it might fall further. No one cares. Because on the long run, like, here's the worst thing that could possibly happen, Anthony. Right? And by the way, and I mean nothing bad by it. It's just I'm trying to teach you here, right? The worst thing that could happen is you stay short and you make a lot of money. Because you're going to do that again and again and again. But most of the time, Anthony, it does this. That's why I have rules of engagement. So you'll make, let's say, an extra 100 pips here, but you're going to have to lose 5, 6, 7, 8, 9 more times before you finally appreciate the lesson I'm trying to give you. So this time you make 100 pips, but over the course of 2020, you're going to lose 900. And then you'll say, oh, that's why, right? That's why Wayne says that. Well, I've already paid that penalty. Like, you don't have to go through that pain, right? You don't have to. Now, you might do it anyways, and so be it, right? Right? So be it. Cool. All right, another pair. Let's go. Let's get some more in. Let's go. Yeah, right? You'll take your profit and sell it high later. Don't worry about it. I love the idea of just like, it's like the second week of December and you're done for the month. You're done for the year. You're like, I'm going on vacation. Imagine losing a reasonable chunk of money or giving back opportunity costs. Let's say, I'll make up a number, $10,000. But you could have gone to like the Caribbean and stayed in a hotel for like 2 weeks and just sat on the beach and maybe did some scuba diving, eating some fresh food, right? But instead, you were stubborn and lost money to the market. You could have spent it on yourself. You could have given it to charity, right? Pound yen? Well, we already know the pound, guys, so I'm going to do euro yen. We already know the pound. Like, we did pound on 2 other currencies. Just extrapolate, and right, it's just an iteration of the same thing. So anyways, let's look at this one. Okay? All right. So here we are. This is where I'm short. And this is where we are now. Yay! So it's been all right. Here's Friday's day trade. That worked out really nice. So the day trade today is to buy it off the double bottom if you're a bull. And they haven't done that. So it makes me feel pretty good. So I have to decide now, sell here, which I don't really like, or sell a little higher. So that means I think we're going to have a false rally. And I got to be careful because this week is a very fundamental week. Like I have to say it again. Remember 9 months ago, I said this week is fundamentally important. That it may reverse all markets temporarily. How many people can confirm 9 months ago, 6 months ago, 3 months ago, I said this exact week? In fact, I said the 12th of December because on the 11th of December, there's a Fed meeting. So on the 11th of December, there's going to be volatility. And then what follows next, we'll probably see on the 12th and 13th. And if it's risk off on everything or profit taking on everything, then I've removed my risk from that. I've already paid myself. My yen pairs were up hundreds and hundreds and hundreds of pips each. More than 300 pips each. They're all money in the bank now. And now I'm preparing to stop, and I have stopped and reversed. And I'm preparing to stop and reverse. And by golly, if next week comes by and I'm up 300 pips across the board on these trades, once again, it'll be me saying, look, I told you so. Now, I don't know if it's going to happen, but I have to tell you, like, oh my gosh, I need to be at least open-minded, right? And look at this trade. You have to understand, I was long this pair for months and months and months, and then right there, I'm short. Oh, like, that's pretty good, right? And to tell you 9 months ahead of time that between this week, which is Thanksgiving, and this week where we're at now, somewhere in this period, I'm going to exit all my yen trades for profit and then reverse the whole strategy. And I did. So I don't know if I'm right. I might just get busted out with a whole bunch of break-even trades, right? And I told you earlier, I think it was around this Thanksgiving period, maybe the Thanksgiving we came back. I said I expect to break even, right? And I told you, look, if I break even on dozens of trades, I'm okay with it. And I've trained myself over the years to say, look, I'm okay with breaking even this time of year because I'm trying something specific. I know I'm a first mover. I don't want to risk, so I'm not going to take a lot of risk, right? I'm going to have my stops closed. I'm going to move them close. And if I break even 22 times, I had the opportunity to make money. I took the shot. I didn't lose anything. It didn't cost me anything, but I got free opportunity across the board. So I'm okay with that. But if I'm right, OMG, I'm going to get paid. So I'm willing to break even a whole lot and get free opportunities with the chance that I get paid. And then don't worry, I'll set up my long-term trades later. I'm just, right? Remember what I told you? We call this rebalancing. Do you remember that? I was teaching you, this is wealth management. This is portfolio management. I'm rebalancing. And part of rebalancing is getting rid of some of your losers, right? Take them now. They're a wash sale against taxes, profits you've made in other businesses. You're going to have to have taxes on them, but you can wash some of your losses in your trading by getting out of them now, taking the loss and washing it against your winners. It's a tax strategy. And then more profit taking is going to happen early in the year for tax deferral. These are your big winners. So you get rid of your losers in December, and then you get rid of your winners in January. And in that period of rebalancing your portfolio, you're still selling. Remember, most asset managers are buyers. They're not sellers. There are very few short sellers. There's, right? Very few hedgers. It's buy only is still probably 70% of the market. So if all those buyers are at least temporarily getting rid of losers, which means they're seller, and then in January getting rid of their winners to defer their taxes that they're going to have to pay on, it's a great tax strategy. You defer taxes for 16 months. Boom. So you do that in January, which is another form of selling. So I didn't say the market's coming down and crashing is the end of the world. What I'm saying is I can see it coming. I'm going to get out of my winners so I don't have any pullback risk. I'm going to take that money and put it in my pocket so I can spend it on, Christmas. And then what? I'm going to make money in the meantime because I can anticipate the moves. So if there's going to be wash sale profit taking in the end of December, great, I'm going to make money. And if there's tax deferral selling in January, good, I'm going to make money. And then what am I going to do? I'm going to rebuild my portfolio, but probably not till February or March. And then we start this whole process over again. In March, my fields are melting. I'm tilling my soil, right? In February, I'm rebuilding my tools. I'm making sure my tractors are in good shape. So in February, I can till the soil. In April, I can start planting, right? I'm preparing ahead. And if I'm right, I'll make a lot of money. If I'm not right, I'll either lose a little bit or I will lose nothing. That's why keeping your losers small and letting your winners run is so important. I have a hypothesis. I'm backing it up with analysis, both technically and fundamentally, and I'm taking my time to build that strategy. Okay? And if I'm wrong, let's say in a week, let's say Trump does a deal with China and this just goes like this. Oh, look, I lost 4 pips. If I had a free shot, oh, you'll say, well, Wayne, I could take profit here and snag. What is this? I'm short at 121. We're at 20. So I have 100 pips. Well, I got chunks of corn bigger than that. So like, I want 1,000, well, I won't say that. I want 333 pips on this, or I'm happy to take the -4. I am not going to take 100 pips profit. Okay? Let's call it a plan. Cool, right? So now what's the next setup? I think this is going to rally up, and next week I will be selling around 120.80 or 121. Oh, 121 is too far there, too high. I guess this is 121.30. So that's probably going to happen sooner than later. Yeah, see, I'm still not aggressive enough to really get in, especially with this week. Okay, going back to the fundamentals. Like, this is a sell zone right now. I have the roll reversal. I have the pivots. I have the moving averages. I have everything I need. I don't think I'm going to do it. The S&B could say something. The ECB could say something. The Fed could say something. Trump could send a tweet. OPEC could do something. There's a lot of risk associated with this right now. And I understand I'm in like a rock star. Okay, but I'm going to go out like a rock star on this one as well. Okay? I'm either going to make massive money or I'm going to break even. Adding now with all this risk, I feel like I'm still in first mover, and there's no first mover advantage. So if I were to bust this out to a 4-hour, let's say, I would not be shocked in the least if price goes all the way up here and then back down. Okay? So I don't want to sell here. Even though I have permission, I'm just not that aggressive yet. My conviction does not match market conditions. And so I'm short here. That's cool. I'm making money. That's cool. I got no risk. That's cool. Do I add another one? Normally I would. This time, I don't think I will. Okay? Okay, Aussie Swiss. I can tell you right now, I want that one to go down. Okay? Impermanent bean. Oops. I can tell you right now, I want it to go down. So that's going to be like, that's my alpha. Not that it will go down. I want it to go down. I would plan for it to go down. I would look for reasons for it to go down. But let's take a look and see if market conditions match my strategy. Okay? You can even see I have it planned going down. See, I have plan A, sell here, or plan B, sell there. It's much more of a plan B. So you can, I probably had it on a smaller time frame. Yeah, see, that's a sell here. Can you see it up and then down, or higher up and then down? Okay. So let's get rid of some of this because it's pretty ugly. Reset and look for congruency or confluence. And this is incredibly neutral. It's not going up or down. So right now, both Aussie and Swiss franc are likely weak. And my anticipation is Aussie will stay weak. And out of the blue, for no particular reason, Swiss franc's going to get strong. Okay. If you were a swing trader, this was your sell last week. So you'd be short in there. So let me delete that, and we can zoom in a little bit. So this area right here is where you should be in, 67.77-ish. Okay, a little lower is acceptable too off the M3, and that's 67.71. So if you're short around 67.70 to 67 or to 68, so the up into the 68 and down, all of that's good. Okay, if I remember correctly, I shorted in here and I got knocked out at break even here. Had a free look, free opportunity. Okay, but whatever. Next time. Because I understand markets are rolling over and selling here is too aggressive. Selling here is 50-50, and selling here, the odds are in my favor. So I need to let it roll over. So sort of like the next, right? I need to be doing this, selling rallies now as part of that rollover. Okay? Next, how can I help you? Ooh, there's a nice short. Yeah, pivots are counted in the past, but they're leading indicators. They're measuring the market. Okay, they're measuring market support and resistance and incorporating sentiment. So you can almost use it as a sentiment indicator. Okay, USD CAD. La 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 la. Okay. Let's go back to the hourly. If you're a bear, that's an obvious sell. It's a weekly M3, 3,300, and a monthly M3. It dropped like a ton of bricks. Okay. And now you're in a roll reversal. So if you're a bear, you probably took that shot, and now it's made a lower low. So the best thing you could look for now as a bear is maybe a down to 32, an up to 32.50. It's in there somewhere, I think. And then down. Okay. And then you should be prepared for a challenge in here. Okay. Most likely your next opportunity to short will be there. Now it's the same price as where we are now. So you'll say, well, Wayne, why not to short now? I'm trying to give you the same opportunity with less risk. Trying to teach you to get the same reward with less risk. Okay. But if you were like, you're supposed to be here. That's where you're supposed to be. This is supposed to be your reload. So this should be trade 1 for you. This should be trade 2 for you. This would be trade 3 for you. And then you might want to consider taking profit on all of these. Or at least pay a lot of attention when or if you get there. Most likely you will. When you get down there, pay a lot of attention to what the market is telling you about the potential. So this potential trade here is giving you the potential to go there. So if you do get a down, an up, a down, hopefully it goes a little lower first and then gives you permission. But if it hits like exactly 31.71 and then starts to pop aggressively, be open-minded to take your money and run. Okay? But normally you would assume this, some sort of pattern like that. Okay? Hua? Ah! Cool. Next. Give me another one. I gotta move. I gotta move. Give me some juice. Hey, by the way, did you guys give me the thumbs up? I'm well over 2 hours now. Can I get a little likey? And if you're new, would you please subscribe to the Forex.Today YouTube channel so that I can work with you tomorrow and the next day 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 and the next day. Join the team, join the community, get involved, participate. Pound CAD. I just showed you a strong CAD and a strong pound. There's no way I'm going to look at pound CAD. Thank you, Hope. Thank you, Tak. I just can't do it. I just can't do it. Like, I'm not going to look at it. I'm sorry. Yeah, I miss Hong Kong. Make sure it doesn't get ruined, all right? Kiwi what, Jimmy? Yeah, I've done at least one Kiwi. Okay. Pound Aussie. Well, so like, look at it this way. We looked at pound. It's a bit overvalued, and we got a lot of geopolitical risk with the pound with the election on Thursday. If you think the pound is strong, just find something weak and trade against that. But to ask me to do pound Kiwi, then pound Swissy, then pound Aussie, then pound this and pound that, like, no. You should be able to do it. I've done enough where you should be able to do the rest yourself, right? So remember, I'm not trying to confirm or deny your trades for you. I'm trying to teach you how to analyze the trades so that you can make better decisions and make better plans. But I'm not going through all the pound pairs simply to confirm or deny what you're doing. Okay, because there's more that I'm doing than what you're doing. So I've done enough pound trades that you should be able to carry out the rest on your own. Euro ZAR. Okay, we haven't done that one. So I got to go to my exotics. So these commodity plays and exotic plays are, struggling a little bit. So this is not my entry. That's my stop loss. So I'm short right here. Okay. This is where I'm short. And this is where we are now. This is where my stop is. So I can move my stop a little bit closer. Okay. And what obviously, hope's not a strategy, as I've already, pointed out. But what I kind of need is this. Okay. And we're just slightly below the current mean. So let me adjust the analysis here. Okay. We're basically at the mean. There's no real reason for me to do anything. On a weekly basis, let me zoom in now. On the smaller time frame, if I was a bear selling this, which I am a bear and I am selling this, this is the critical pivot and this is the critical pivot. So this whole area in between, right, was the sell zone. Okay, this is this week's sell zone. So as long as we're below that, I'm pretty okay. I'm making money. Okay. And we're getting caught on this price. Like basically somebody, and maybe it's the South African government, I don't know, but we're stuck on 16. So if we can get through 16, this might drop hard, huh? But we haven't even tested 16. So if we're just going to use flat out technical analysis this week, then the trade plan basically was, oops, don't want to do that. The trade plan for this week is something like this. Okay. Actually, it's tighter than that, isn't it? Okay, it's actually more like this. So I got to let that happen. Okay. So my choice here, instead of adding, I can move this and lock in another couple hundred pips. I don't know if I want to. So, yeah. Yeah, I have an entire training course. EJ, fxbootcamp.com. Okay, just go to fxbootcamp.com. All right, cool. Anything else? The lira has been a little more troublesome. So I'm pretty close on lira and bailing. I think I told you earlier in the week. Oops. I think I did. I'm pretty sure I did. Maybe it was last week with the swing trading group. But I knew this was massive support for the lira. And they'd probably go up and I have to make a decision. I think what I said is if we go above this zone, I need to get out. Probably just the smaller trade, like the smaller profit, not the bigger one, right? So to say that kind of differently, this one here, so I'm short here, right? Let's delete this other stuff. I might, if it goes higher than this, I might just take the profit. It's a small profit, but I've been earning yield, right? What does this one pay? 1,100% per year. So I've been earning yield the whole time. A little disappointed, but technically speaking, I need this to be rejected. Okay. If it doesn't, I'm not going to feel good about it. Okay. And then going further out, I'm still short way up there. Okay. So we'll see what it does around this 650 mark. I want 650 to hold. Okay. Yeah, makes sense, Famobix. It's set up for it. 618 here, M2 there. So I did talk about it in the swing trading group, but anyway, so we'll see. I'm trying to stay brave and use technical analysis. But if you got out last week, that was good. Daniel says, why is a bear always a bear? Most traders tend to be both, right? Yeah, most traders also tend to be losers. Okay. There's no professional trader that just trades randomly all the time. You can't even raise money. Okay? If you don't trade other people's money, then you're also not, by definition, a professional trader. No one's paying you. You understand? So for you to raise money, you have to tell them what you're going to do before you do it. You have to explain the risks associated with what you do. And generally, you have to explain the reasoning. And also, they're going to have general questions about your outlook for the world because they have other concerns. So they'll say, "Oh, what do you think about gold? And what do you think about real estate? And what do you think about the German economy? And what do you think about Hong Kong? What's going on there? And what do you think about this? What do you think about that?" And if you look at them and say, "I don't have any idea about anything. I just sit down and I long bomb today and I short sell tomorrow and I make 9 different trades in a day. Some are long, some are short, some are this, some are that. I really don't know what's going to happen tomorrow, yet alone next month or next year." You will never raise money ever, 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 ever. So that's why. That's why a bear is always a bear, because it's backed up by analysis. Okay? Right? Well, you got to start with the technical analysis, right, Yolan? You got to start with that. That's where most people are. And then they have to learn the rules of engagement as well as things like fundamental analysis and all that kind of stuff, right? So, my number one goal in these free webinars is to open people's eyes to not even a better way, like a real way. Like, my job is to show you the matrix, blue pill, red pill, right? And I'll show you reality. Most people come in and they don't see reality. They're either, most likely they're uneducated. Not I don't mean like school uneducated, but they just don't know anything about trading. Well, time will take care of that, right? Like, I will teach you that. Sometimes there's a level of desperateness. So I got an email from someone saying that they needed a coupon code to my swing trading group because they don't have any money and they have a sick child. And they want to join the swing trading group to make a whole bunch of money quick to pay for their child. What's the problem? What's the problem there? What should I tell this person? Yeah, Yolan, absolutely. Actually, I used to actually teach people on a regular basis. We called it how not to trade. I used to do it on a regular basis. People really loved it. But I kind of do it today. Like when I looked at something earlier today, I'm like, I don't like those conditions. It's not what I'm interested in, and I just pass. That was definitely how not to trade. Yeah, but right? So like really if you think about it, none of the courses, none of these free webinars, none of the paid stuff I do is about making you money. I don't promise anybody to make anybody any money unless I'm managing your money for you. Okay? But there's a difference between like receiving an education and getting good experience. Like the live stuff is about getting good experience, right? Either you're going through live FX boot camp and you got a mentor and they're like, do it again, do this right. You're sloppy here, do this better. Let's do it again, do it again, do it again, do it again. That increases your skill, right? And then like my swing trading group is much more about the experience. How do I feel in this situation? Why would I take this? Or why did I take this? Why didn't I take this? What were the fundamentals that influenced this? I missed this. How do I get in later? Or I took this and it wasn't good. What do I do about it now? Like all these things is about experience, about skill, about exposure to knowledge. But it's not necessarily about making money, right? That's an easy trap to fall in. Oh, that Max, that's in the Taking Control course at fxbootcamp.com. Mr. High Volt, most likely you don't have enough money. 99.9% of people on Earth don't have the money. But right now, anyways, I'm focused on other things. But like, let's do the math. Let's say I charge you 20% of the profits. And I do 5% a month. Let's say I double your money every year. You keep 80%, I pay 20. Okay? So if you got 50 to 100 million, maybe 10, let's start small. If you have $10 million of risk capital, we can talk. But risk capital, you have to have a fully invested portfolio in stocks and bonds and real estate and all this kind of stuff. And that 10 million would be risk capital allocated toward alternative investments as part of your portfolio, and to try to lower your risk and volatility of your overall portfolio. So if you can show me that, then we can talk. But otherwise, I don't earn enough money for it to be worth time, right? So just makes sense, right? Like, for example, if it was 100,000 and I doubled it, which is an incredible amount of work, right? You're going to pay me 20 grand? I'm not interested in 20 grand. Right. I don't need to put in that much time, and all the costs associated with being like regulated and all that kind of stuff, and all this, the risk and just the effort and the concentration and the stress, like for 20 grand, dude, that doesn't even buy me a used Honda. Not interested. Right? So it makes sense if you think about it that way. I'm not trying to be arrogant. It's just like, it's not worth my time. Right? So anyways, I mean, it doesn't even, yeah, well, whatever. doesn't pay for Harvard. It doesn't, I mean, just, it's not enough money. But anyways. All right. So Coolio. What should we do? You know what? Why don't we pull the plug and just regroup tomorrow? Did you enjoy today? Was today good? Okay. Yeah, that's true, Ed. Well said. Yolan says 800% profits in 10 weeks. Yeah, you would never attract institutional money, though. Cool. Thank you, guys. Yeah, that would make sense, right, Mr. Highvolt? But right? So you like the gold part? Cool. Well, thank you for being in my life and being part of this community that we've built at YouTube. I think it's really cool. I think it's really special. Okay. So thank you for supporting it by subscribing and leaving comments and clicking the like button. And maybe if you have a friend, bring them next time. But just thank you for helping me create something good in the world. And thank you for being part of it. So peace on earth. May the pips be with you. May our profits be above average. And I will see you tomorrow.